Wall Street in 1929 seemed invincible. Stock prices had been rising for almost a decade. Fortunes were being made overnight, and everyone, from shoeshine boys to bankers, was trading stocks as if it were a guaranteed path to wealth. The Dow Jones Index had tripled in value between 1924 and 1929. Credit flowed like water, speculation was rampant, and the American dream seemed within reach for anyone bold enough to bet on the market. But then, in October of that year, reality collapsed with a violence that destroyed lives, wiped out entire fortunes, and plunged the world into the Great Depression. And here's what should scare you. The same patterns that led to 1929 not only resemble what we see today, they are almost identical. And if history teaches us anything, it's that markets don't just stumble. They collapse when everyone least expects it and crush precisely those who trusted the system the most. The story of 1929 isn't ancient history. It's a manual about what happens when speculation replaces investment, when debt becomes a way of life, and when governments convince themselves they've conquered the economic cycle. Now in 2025, surrounded by record highs in the stock markets, unprecedented debt levels, and a financial system more fragile than ever, the echoes of that collapse grow louder every day. Let me show you exactly how the 1929 crash happened, why it devastated millions of ordinary Americans, and most importantly, why every warning sign of that tragedy is flashing red right now. The Roaring Twenties didn't begin with a roar, but with a lie. After the First World War ended in 1918, the United States found itself in a unique position. European economies were in ruins, their factories destroyed, and their young men dead in the trenches. Meanwhile, American industry had expanded during the war. The banks were full of gold, and American companies faced less competition than they had ever imagined. It looked like prosperity, but it was merely luck disguised as genius. In 1920, the Federal Reserve cut interest rates to stimulate growth, making credit cheap and abundant. Money flooded the economy, and much of it ended up in the stock market. At first, that seemed reasonable. Companies were genuinely growing, profits were real, and stock prices reflected genuine value. But cheap money has the power to corrupt everything it touches. When borrowing costs nothing, speculation becomes indistinguishable from investment. By around 1925, something fundamental had changed. Stock prices no longer rose because companies were worth more, but because more people were buying stocks, and more people were buying because prices were rising. It was a self-feeding cycle, a mathematical illusion disguised as an economic miracle. Every dollar that entered pushed prices higher, attracting more dollars, and so on. But the real danger came from leverage. Banks not only lent money to buy stocks, they also created something called buying on margin, where an investor could purchase stocks by paying only 10% of their value and borrowing the rest from brokerage firms. Imagine buying a $100 stock with just $10 of your own money and $90 borrowed. If it rose to $110, you doubled your money. It looked like free wealth, and everyone wanted in on the game. But leverage is a double-edged sword. If that stock dropped from 100 to 90, you lost your entire investment and still owed money. By 1928, margin buying was so common that the total amount borrowed for speculation reached $4 billion, about $60 billion in today's dollars. And now, in 2025, margin debt is once again at record levels. Investors are borrowing more money to buy stocks than at any other point in history. Just like in 1929, cheap money from central banks has flooded the markets, pushing prices to absurd levels. And again, everyone believes that this time is different, that technology and government intervention have eliminated the risk of a real crash. But what made 1929 so devastating wasn't just speculation, it was the debt behind everything. By the late 1920s, American consumers were going into debt like never before to buy cars, radios, refrigerators, and houses. Consumer credit exploded, allowing families to buy what they couldn't afford with money they didn't have. Stores offered installment plans, car dealerships financed vehicles, and banks competed to lend to anyone with a pulse. This wasn't economic growth. It was economic illusion. People felt richer because they could buy more, but they weren't earning more. They were simply borrowing from the future, believing that tomorrow would always be more prosperous than today. And that sounds familiar, doesn't it? Companies were doing the same. They borrowed money not to produce more, but to buy back their own shares and artificially inflate their prices. They created trusts and holdings, layers upon layers of speculation built on speculation. By 1929, some of these funds were leveraged 20 to 1. A mere 5% drop was enough to destroy them, but no one cared about the risk, only the profits. Warning signs were everywhere. Production was slowing, unemployment was quietly rising, and consumption was beginning to fall under the weight of debt. Even so, the market kept climbing, sustained only by the belief that it had to rise. Optimists claimed that the United States had entered a new era of permanent prosperity, that the old cycles of boom and bust were over. Then came October 1929, and within a few days, everything collapsed. October 24th started like an ordinary day, but ended as a nightmare. Some major investors began selling, and the house of cards crumbled. Margin calls exploded. Millions of people owed money for the stocks they had bought, and when prices fell, brokers demanded more collateral. But nobody had any money left. Everyone had spent and borrowed everything they had. Forced selling began, turning into a death spiral. The more people sold, the more the market fell, generating more margin calls, more panic, and more selling. It was a collapse in real time. 5 days later came the dreaded Black Tuesday, October 29th, 1929. That day, 16 million shares were traded, a volume so enormous that the system couldn't process it all in time. Prices didn't just fall, they went into free fall. Solid companies lost half their value in just a few hours. Fortunes vanished, lives were destroyed, and confidence in the American dream simply evaporated. Brokerage houses collapsed, and chaos took over Wall Street. Desperate investors crowded the streets in front of the New York Stock Exchange, watching their savings melt before their eyes. The noise from the trading floor could be heard blocks away, a sound of shouting, insults, and despair. The legend of brokers jumping out of windows was born there, symbolizing not just financial collapse, but the emotional breakdown of an entire generation. But the truth is, most tragedies came later, when the full extent of the losses became clear. Panic spread like wildfire. Banks began losing money and calling in the loans they had issued. Businesses that depended on credit shut their doors. Millions of people lost their jobs within months, and with unemployment came hunger, misery, and the disillusionment of a nation that believed it had conquered the world. The crash of 1929 didn't just destroy fortunes, it destroyed faith in progress. People learned, in the cruelest possible way, that the financial system was a fragile web held together by collective trust. When that trust broke, everything collapsed with it. The stock market crash was only the trigger. The real enemy was widespread indebtedness. When one thread of the web snapped, the entire structure unraveled. And that is the anatomy of a systemic collapse. It doesn't happen because of one bad decision or one isolated institution. It happens because everything is interconnected. Banks, corporations, governments, and ordinary people. When one link breaks, the rest follow in a domino effect. The market was only the spark. The powder had been scattered long before. Now fast forward to 2025. The scenario is eerily similar, only on a much larger scale. Debt is higher, speculation is more sophisticated, and the system is infinitely more interconnected. Today we have derivatives funds, cryptocurrencies, and artificial intelligence. But human psychology remains exactly the same. People still believe that prosperity is eternal, and that central banks will always prevent a crisis. History repeats itself with new disguises. Just like in 1929, collective euphoria has replaced common sense. Artificial interest rates, monetary stimulus, and easy credit have created an environment where risk seems to have disappeared. But it hasn't. It has only changed form. Behind every record valuation, there is debt quietly growing in the background. Modern investors swear that this time is different. They say that technology has changed everything, that automation and artificial intelligence will guarantee infinite growth, that the government can intervene whenever something goes wrong. But that is exactly the kind of optimism that precedes every historical collapse. Before disaster, there is always a chorus of voices saying that the old world is gone. But the old world always comes back and charges a high price. When speculation replaces investment, when debt replaces income, and when prices disconnect from reality, the result is always the same: a brutal correction. And when it comes, it doesn't just affect greedy gamblers. It also hits ordinary people, retirees, workers, entire families who trusted the system. Because a financial collapse is never purely economic. It is psychological, spiritual, and social. It breaks not only wallets, but identities. History does not repeat, but it rhymes with terrifying precision. And the question is not if another crash will come, but when. When confidence breaks, when fear takes over, and when the same mistakes are repeated, the result will be the same: destruction. But as always, some will be prepared. While some lose everything, others will be ready to rebuild. And when that moment comes, there will be only two kinds of people: those who watch their wealth vanish overnight, and those who prepared while everyone else was celebrating. Those who doubted the system when everyone believed in it. Those who kept liquidity, avoided debt, and strengthened themselves in the storm, while others rejoiced in the calm. The 1929 crash was a tragedy. The one in 2025 will be a lesson, because collapses not only destroy, they also redistribute. They transfer wealth from the unprepared to the prepared, from the leveraged to the prudent, from the dreamers to the vigilant. Every fall is a cleansing, a brutal reconfiguration of what truly has value. But it takes courage to see that before the impact. Courage to leave the herd when everyone else is heading in the opposite direction. Courage to question what seems obvious and doubt what everyone else says is safe. Those who survive are not the smartest, but the most aware. The ones who understand that real power lies in anticipation, not reaction. And that's why history remains the best teacher we have. It repeatedly shows that excess is always punished, that blind optimism is always costly, and that economic arrogance is always temporary. Those who believed in infinite prosperity were always swallowed by their own delusion. And those who understood that nothing lasts forever, those were the ones who thrived amid the ruins. Therefore, the question is simple. Which side will you be on? Because the next great crisis won't be only about numbers or indexes. It will be about awareness, discernment, and preparation. The same signs from 1929 are flashing before us, only now much stronger. The difference is that this time, the responsibility will not lie with Wall Street. It will be yours, and with the choices you make before the tide turns. History is not a ghost from the past. It is a mirror of the present. Each generation believes it is smarter than the previous one, that it has learned from its mistakes, and that this time is different. But what changes is not human nature. It's the disguise of illusions. In 1929, people bet on steel, coal, and railroads. In 2025, they bet on data, chips, and artificial intelligence. But the desire is the same: to get rich quickly, without understanding the cost. Financial empires do not fall from lack of technology, but from excess of confidence. The danger is not in the debt itself, but in the belief that it never needs to be repaid. It is not in speculation, but in the illusion that the cycle can continue forever. And while the world spins in euphoria, few realize that the foundation is cracking. Economic arrogance always announces its own downfall, disguised as progress. When confidence breaks, the fall will be swift, ruthless, and global. Algorithms will sell before humans even understand what's happening. Screens will flash red, numbers will plummet, and denial will turn into panic. The same voices that once shouted buy will now say, "No one could have seen this coming." But the signs were there all along, visible to anyone who still knew how to look. Because collapses, at their core, are a form of purification. They strip away excess, topple false gods, and return reality to its throne. They are not punishments, they are corrections. And every correction is painful, but necessary. It is the world's way of reminding us that nothing is eternal. Not euphoria, not empire, not money. So, before the next collapse arrives, stop and look around. Ask yourself, what do you blindly believe the system will protect you from? History has already given all the answers. It's just waiting to see if you're listening. Because when the cycle closes, what today is comfort will become ruin, and what today is caution will become power.